Imagine walking into an orchard and seeing a tree laden with ripe apples. You don't own the tree, but you can make a deal with the owner to buy those apples at a certain price on a future date. That's a simple way to understand what derivatives are. They are financial contracts that derive their value from an underlying asset, like those apples or stocks, bonds, commodities, currencies, interest rates, and market indexes. In the financial market, derivatives are like a safety net. They help individuals and institutions manage risk and can also serve as a tool for speculation, allowing investors to profit from changes in the underlying asset's price. Now, derivatives can be traded in two main ways: over-the-counter, commonly referred to as OTC, and on an exchange. But before we dig deeper into these two main ways, let's take a step back. What are derivatives to begin with? To put it simply, a derivative is a contract between two or more parties, whose value is based on an agreed-upon underlying financial asset, index, or security. These underlying entities can be bonds, commodities, currencies, interest rates, market indexes, and stocks. This kind of financial instrument allows individuals and corporations to speculate or hedge against future price changes. This concept of derivatives forms the fundamental basis of much of our modern financial system. Coming back to the topic, two main ways that derivatives can be traded are over-the-counter, OTC, and on an exchange. The manner in which these two ways operate is fundamentally different, and each has its own unique characteristics and implications. Let's first analyze over-the-counter or OTC trading. OTC trading is commonly referred to as a decentralized way of trading. This is because it does not take place on a centralized exchange. Instead, it happens directly between two parties. One could visualize it as a one-on-one negotiation, happening and without the interference of an exchange. This method of trading derivatives is often chosen when the parties involved desire more flexibility and discretion in their transactions. They can negotiate the terms and conditions of the contract to match their specific needs and risk tolerance levels. This flexibility can, however, also lead to a higher level of risk as there is no regulatory body overseeing these transactions. On the other hand, we have exchange-traded derivatives. These are radically different from OTC derivatives. The trading of these derivatives takes place on an organized, regulated exchange where many different parties can participate. This marketplace is often bustling with activity, with dealers and brokers interacting with one another to buy and sell contracts. These contracts are standardized by the exchange, meaning that they have predetermined terms. This standardization ensures a level playing field for all market participants and of default. Let's delve a little more into how exchange-traded derivatives work. Imagine a bustling marketplace, bustling with traders, investors, brokers, and dealers. They are all there for a singular purpose: buying and selling contracts. These contracts, standardized by the exchange, stipulate the terms and conditions agreed upon by the parties involved. The standardization of these contracts brings a level of transparency and security that is absent in OTC trading. It ensures that every player in the market is aware of the terms of the contract and is able to evaluate the risks involved. Now you might wonder, which one is better, OTC or exchange-traded derivatives? The answer to this largely depends on the goals and risk tolerance of the traders involved. OTC trading offers more flexibility and privacy, but it also bears a higher risk due to the lack of regulation. Exchange-traded derivatives, on the other hand, offer more transparency and security at the cost of flexibility. Therefore, the choice between the two ultimately depends on the needs and preferences of the individual trader or institution. In summary, whether you choose OTC trading or exchange-traded derivatives, understanding the fundamental differences between the two is crucial for success in the world of finance. It's important to note the advantages and disadvantages of each, and make an informed decision based on your individual needs and risk tolerance. On the other hand, exchange-traded derivatives are like a bustling marketplace, where contracts standardized by the exchange are bought and sold. OTC derivatives and exchange-traded derivatives stand in stark contrast. OTC derivatives are tailored to meet specific needs. Think of them as a bespoke suit designed to fit just one person. They can be customized in terms of contract size, expiration date, and the asset involved. However, this customization carries a certain level of counterparty risk, the risk that the other party will not fulfill their end of the bargain. Exchange-traded derivatives, however, are more like ready-made clothing. They come in standard sizes and styles, or in financial terms, contract sizes and expiration dates. The exchange itself acts as the counterparty to every transaction, which significantly reduces the risk of default. Among the most common types of OTC derivatives are forwards, swaps, and options. Forwards are contracts to buy or sell an asset at a specified future date at a price agreed upon today. Swaps allow two parties to exchange cash flows or other variables associated with different investments. Options, meanwhile, give the buyer the right, but not the obligation, to buy or sell an asset at a set price on or before a certain date. The flexibility of OTC derivatives makes them a significant player in the financial world. They enable companies to manage their risks better and allow investors to execute complex investment strategies. For example, an airline might use OTC derivatives to hedge against potential increases in fuel prices, while a global corporation could use them to protect against fluctuations in foreign exchange rates. In conclusion, OTC derivatives are a crucial component of modern financial markets. They offer a level of customization that exchange-traded derivatives cannot match, providing a valuable tool for risk management and investment strategy. However, with great flexibility comes increased counterparty risk. Therefore, understanding these instruments is key to navigating the financial orchard effectively.